Good morning, everyone. My name is Pushpalata. I am going to explain the subject income tax law and practice. The topic is house property. The income from house property refers to income earned from buildings or land other than that assessee is the owner of the land or building. The tax is charged on the annual value of the property and not an actual rent received with expectations. The essential conditions are the income tax is under this head if there is a house property, for example, building or land attached of it. Then second one is the assessee is the owner, legal or deemed. The third one is the property is not used assessee on own business or professions. These are called the house property. Next, will income chargeables. The types of properties are derived into four types. First one is self-occupied property (SOP). Next one is let out property (LOP). And third one is deemed let out property. Fourth one is partially self-occupied and partially let out. First, we will see the property, self-occupied property. The annual value is nil, but deduction of interest is housing loan up to 2 lakh. The loan taken from purchase or for the yearly ones. Next, we will see the let out property. The let out property is computation of gross annual value, expected rent or actual rent received by receivables. But the net annual value is derived from municipal tax paid by the owner. Deduction under section 24. Standard deductions 30% of net annual value, then interest on borrowed capital. For example, actual rent no limit. The self-occupied house means the self-occupied property, the annual value is considered nil. The providing refers to the home of income tax. Overview is the section 23 outlines how to determine the annual value of the property, which is the basis for calculating the taxable income. How to calculate the tax deductions means first, the standard deduction is 30% of net annual value. Then interest on loan, actual amount to be paid to the taxable amount. Loss for the house property means first one is loss allowed to set off on income from 2 lakhs in year. Then balance loss can be carried forward to as 8 assessment years. For example, Mr. X, owner of his house, who gave the letter to 15,000 per month. Municipal tax paid 12,000 per year. Then interest on housing loan 60,000 per year. Then calculation of gross annual value 1,80,000 and net annual value 1,68,000. The standard deduction rupees for 30%. So the actual calculations is 50,400. The interest is to be 60,000. The finally the house property income rupees 57,600 for the particular person of X. There are many importance in this house property. Rental income from slab rating, then income from other sources. Properties used for own business are not taxable under this head. Municipal tax also must be paid to the municipal office. The deductions are allowed under section 24, standard deduction, interest deduction and tax burden deductions. There are three categories. The standard deductions is 30% of annual value. Then interest deductions means the purchasing, constructions or repairing property is deducted without any upper limit for self-occupied properties. Then these tax burden deductions, these deductions lower taxable income. That is the deductions. This is the burden of property owner to the owner to the property. The property name of another tax liability, right of ownership responsibility, then importance of documentation. The tax liability means the income is taxable, the heads of actual property owner. Then rights of owners responsibility means ensure that the owners responsible to for tax in respective of the particular period of time. These are the points included in the house property. Thank you for this session. We will see the next session for next topic. Thank you.